Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Tom Dunkel. He has over 27 years of real estate, finance, and investing experience. His company, Belrose Asset Management, is involved in private lending, distressed debt, and self-storage complexes. So thank you so much for being on the show today, Tom.
Charles, it's great to be with you and the listeners. Thanks so much for having me.
So over almost 3 decades, can you give us a little bit about your background, both personally and professionally, prior to getting involved in real estate investing?
Sure. Wow. When you say it that way, man, it makes me feel a little old, but no, it's true. I guess, time kind of flies when you're having fun, but yeah, I started out in corporate America after business school. I was doing mergers and acquisitions and raising institutional capital. We were doing, $100 million deals, $50 million deals, that kind of thing. I was in the aerospace industry, the IT industry. And so just learned a lot, had a great foundation there, but I always knew I wanted to go out and do my own thing. So after, corporate stints here and there, building that foundation, I jumped into my entrepreneurial career in 2006. So going on about 17 years ago. And of course, that was 2006, wanted to get into real estate. Timing was awful, right? So here I kind of left my cushy corporate world and, jumped into my entrepreneurial world and proceeded to get my butt kicked pretty good those next few years. But, it was a great learning experience, looking back on it, certainly has trained my mind for, our investing today. Because of course we've got some rocky things going on economically. So I've got that background, not only from the Great Recession, but I was in technology investment banking when the tech bubble burst back in the early 2000s. So I've definitely seen bubbles. I've seen how they can build up and burst and, the kind of the outcome from there. So I think that's also given me a good perspective to be an investor. So started out doing residential stuff, started doing some hard money lending as well, but discovered distressed mortgage debt back in 2010. So we've been doing that. Connected with my partner, Joe Downs. We've been partners 13 years. So we've been doing distressed debt that whole time. And so that business has allowed us to branch off into other things. So like I mentioned, hard money lending. But we started, we wanted to find a business where we could really build a team. We could really take advantage of a dislocated, kind of fragmented market. We wanted to be able to really build a business plan, for the future, put systems in place so that as the business grew, we could bring in people to take over our jobs, so we could fire ourselves and, just kind of play more advisory roles. So we found self-storage in about 2017, 2018, started really getting educated about it. 2019, we joined a self-storage mastermind group, which is a nationwide group of self-storage investors. Through that process, we learned we had some gaps in our team that we needed to fill. So Joe and I are good numbers guys, deal guys, putting the financing together, those kinds of things are our strengths, running the projections and the underwriting, that sort of thing. But we didn't have the skill set of finding the off-market deals. So through our mastermind group, we found Tim Kane. He's an expert at finding off-market deals. So we brought him in. And then, of course, you can find the money and find the deal, but now you got to run the thing, right? So we had that operations gap. So through our mastermind community, we were able to find Catherine East. She's a 17-year industry veteran. She's former executive director of the Missouri State Self-Storage Owners Association. She's done management consulting, transition work, and auditing work on hundreds of facilities around the country. And so we brought her in to help us on the operations side. So then when we had the team together, we had the vision, and then we went out and bought our first facility in 2020. And we're about to close next week on our 12th facility, which will put us up over 300,000 square feet of storage, and the portfolio worth 35 million-ish, give or take.
Wow. Fantastic. That's awesome.
Yeah.
So on our show here, we discussed mostly like multifamily investing. So can you tell us why self-storage complexes are a great asset class to invest into?
Sure. I actually been a passive investor in apartments since 2013, so I'm very familiar with that asset class. But there's a few things that we really, really like about storage. And if you'll indulge me, I can share a couple pictures with you. So this is the first picture. I know you can't see it, but basically it's this line, this nice flat, smooth line on the top. That's self-storage occupancy for the last 40 years. The line that you saw going like this, that's the US economy bouncing up and down like crazy. So we like storage because it's very steady. It's been steady through ups, downs, and everywhere in between. The other chart I'll share with you is market penetration. So in other words, folks are starting to adopt. You saw the curve is going up like this. That means that more and more people are using self-storage. It used to be like maybe 8 or so percent. Now it's up to like 10.5% of households in America are using storage. I know that doesn't sound like a huge percentage increase, but when you consider that there's 120 million households in the US, every 1% increase means 1.2 million additional self-storage customers. There's only about 50,000 self-storage facilities in the US, so that keeps that demand nice and strong. The next slide I'll share with you is you can't even see it, doesn't register right here, but this is the delinquency on self-storage. You've got retail way up there, lodging way up there, office way up there. Self-storage facilities do not default on their debt. And it's because of the last slide, which I'll share with you, this is our KPIs that we track on a weekly basis. And again, I know you probably can't see these numbers and stuff, but our operating expense ratio across our portfolio is 36.7%. So let's call it 37%. So as compared to multifamily, it's kind of the reverse, right? Multifamily, your operating expenses are typically, maybe 70%, which leaves 30% net operating income left over to pay the debt and the investors. Self-storage is the other way around. It's about 35% operating expense ratio, which leaves us 70% of net operating income to pay our debt. And then we certainly have plenty left over to share with investors. So those are the big reasons why we like multifamily, but we like self-storage better. Okay.
That's interesting because as I spoke to someone, self-storage operator a couple of years ago, and they used to say that how they would figure out if a market had enough self-storage, let's say, it would be, I think it was 8 square feet per person in this market. So now has that gone up to 9 or 10? So now because there's been a lot of building of self-storage in the last 10 years. And apparently it's been, it's actually not been an issue because of the more demand. Is that correct?
Yeah, that's 100% right, Charles. So you're right about, and it varies from market to market, but generally speaking, about 8 square feet per person is what we call equilibrium. So if we go into a market and we see that there's less than 8 feet per person, that could be an indication that market's underserved, which would make it attractive, right? As compared to the other side of the scale where it might be 15, 16, 20 square feet per person. That would give us that would give us a little pause, because it would seem that that market is oversupplied. But yeah, the building that's been going on, like I said, there's 50,000 facilities in the country. I think the last couple of years we've been adding maybe 400 or 500 per year. So it's really not a ton more square footage. And as you know, too, being in real estate, everything's very localized, right? So we look at those 1, 3, and 5 mile radius areas around a particular facility that we're interested in. And then, we can move that, especially if we're looking at land to develop, we can move that radius around until we find an area where the supply index is low, but there's still a path of progress, and there's still population growth and job growth. And those are going to be things that we'll find attractive in a particular market.
When you're doing those absorption rates and occupancy rates and figuring out if it's underbuilt or overbuilt, do other classes of self-storage, I'm not sure if this is the right talk, how you would classify it, but different classes of self-storage. I mean, you can definitely drive by beautiful 4-story, all air conditioned. You can put in there your stuff, you put wine in there, all these different things that can go into something in a nice area. Then you might have it 15 minutes out, but, something that's been, let's just say it's a little bit more classic and vintage and something. Right. So with that being said, is that how do you work that into? Are you seeing when these things were built and then figuring out, or if they're under AC, if they're not?
Sure. Yeah. The specific databases that we subscribe to, they're specific to self-storage. So these resources actually break down the market into climate controlled and non-climate controlled storage. And certainly, where you're going to see those big, shiny, newer buildings, those are typically going to be in your metro areas, or maybe, just outside. We have found our niche in the more secondary and tertiary areas, where we're buying the B class and the C class facilities that are mom and pop, earlier vintage, to your point, and maybe they're not climate controlled, but maybe we can add some climate control if the market would support that. But what we found is that that's where the opportunities really lie to increase value in a short period of time and create those great returns for our investors, because a lot of times those are going to be mom and pop run facilities. They're not really on top of the market and where rates are, and they don't really leverage technology to market themselves and do their dynamic pricing and rent to folks on their smartphone. So they aren't really doing those kinds of things. And so we're able to go in, take that B or C facility and spruce it up, add technology, and then really crank up the NOI through our rate increases and our use of technology.
Oh, that's great. That's fantastic. That's a great area to be in with that tertiary market, secondary market, because I feel that those are a lot more recession resilient, because you're going to have people that don't want to get rid of their stuff, but they might move it from that metro area 15, 20 minutes out to be able to save a considerable percentage if something happened in their life, which is usually when I find people are using self-storage is when they're having a major change in their life, for the most part.
That's right. Yeah, that's one of the big demand driver, right? Is when people are moving or downsizing or dislocated, or something's going on, they're looking to store their furniture. Like during the pandemic, right? All of a sudden, gazillions of Americans had to, and other places as well, had to change that extra bedroom into an office. Right. But they didn't want to chuck their bedroom furniture. So they put it in storage. And then similarly, they had to clear out their garage to, make it into their gym or whatever they had to do. So they definitely, needed more space at home, which drove demand at storage facilities. Now that is substantially behind us. We're back into kind of the normal seasonality of self-storage. So right now we're in February. So through the winter months, obviously, things are not as active. People are not really moving as much. So traditionally, that's when self-storage, the occupancy goes down a little bit. But we're now heading into spring, where people are, the spring real estate market's going to pick up. People are going to be buying, selling houses, and that's going to drive demand. So that's typically what's going to make that curve kind of head back up during the spring, summer, and into the fall.
It's amazing how that changes so much. And I know it's in self-storage, as you just said, but I mean, everybody knows it's in multifamily as well, if you're, what you said about the housing, but it's just crazy when we get reports from December or January on rental reports for the week from different property managers to going into March. It's like night and day. You know, it's amazing how people, and we're mainly in Florida, so it's not like the weather, you know, it's an issue for people moving. It's just how the seasons work. So it's very interesting.
Right.
Yeah,
that's right.
So what types of risks do self-storage investors need to be aware of?
Sure. Well, as an investor myself, I've certainly learned about risk along the way, and I would say one of the key risks that I think a lot of passive investors overlook is the sponsor of the deal. So we actually have an ebook that's available on our website. It's a book that I've put together with my partners, and it's just kind of the things I've learned along the way in my journey as an investor. And so the book's called the SAFE checklist, and SAFE is an acronym. S is for sponsor, A is for asset, F is for financials, and E is for exit. So I think a lot of people get excited about the asset and the financials. They get excited about the deal. They really need to start with the sponsor. Yeah. I think is a critical area where a lot of people just kind of skim past that, or they get a glossy brochure, they see a fancy website, and that's kind of enough for them. And then they go right into the deal. They get excited about the deal. And, maybe it is a good deal, maybe it's not, but I would encourage folks to spend a lot more time vetting the sponsor.
Would you consider, other mistakes that you might see, because you work a lot with high net worth individuals? Do you see any other kind of common mistakes other than not vetting sponsors? Because, I mean, obviously that's a huge one.
Yeah, for sure. I think I always encourage folks to really understand exactly what it is that they're investing in. It's kind of amazing to me. Like I know crypto is really hot right now, right? So what are you investing in? I guess if you're really into that world and you're into the technology and the blockchain, all those maybe you can explain it to your teenager or to an older person. But I can't. I mean, I like, that's one of the things I really like about self-storage. It's a very simple business, right? I mean, it's a metal box with a concrete floor and a roll-up door, and people keep their stuff in there. There's no plumbing, there's no electricity, right? It's very straightforward. But I think people need to understand, that they're buying, like if they invest in one of our syndications, they're buying membership interests in an LLC usually that is going to own this land, this real estate that has this storage business sitting on it. And I know maybe that sounds very simplistic, but I think some people say, oh, well, I'm putting money into, they think they're investing directly into the land, but, they're really not. And so I think those distinctions are important as an investor. So, you understand what it is that you're getting into, and also how long you're going to be tied up in that. I think that's another area where folks really need to understand, because they might meet someone they like that has a deal and the returns sound great, and then they realize, oh geez, I'm stuck in this for 7 years.
Yeah. No, I definitely see that. And I know we've gone through this last few years where deals that were supposed to be 5 or 7 years were 2 or 3. And I just have to keep on telling investors it's 5 to 7. Obviously our goal is to hit these numbers and be out sooner. Right. But I mean, you have no idea, you know what I mean, what could happen in the next 3 or 4 years that will slow it down. So you brought up different syndications, and what do you see the main benefits between a single asset syndication, where it might be one single complex, self-storage complex in your business, versus someone that says, we're going to buy 5 this year and you can invest into a fund?
Yeah, that's a good question. And I know there's certainly different philosophies supporting both sides. As an investor myself, I personally like the deal by deal model. And actually for a company like Bellrose Storage Group, it's actually more of a hassle for us. It's a more administrative burden to do it deal by deal, but we still do it that way because again, as an investor myself, I like to know that my dollars are going into a specific asset. And so like we were talking about a minute ago, I know that it's a facility, in Douglasville, Georgia, it's 45,000 square feet. I can look at as my own, to do my own due diligence, I can look at that market myself. I can look at that asset myself. And, I think give the investor more clarity, more transparency, and also just better alignment with the sponsor is how I feel about that. I know there are funds out there, they raise a lot of money, they go to deploy it. And sometimes, so that's where I think maybe there's a little bit of a disparity between the sponsor and the investor, because if the sponsor has all this money, they might feel like they're under pressure to deploy it. And so they might, cut a corner here or there to get a deal done because they don't want to be sitting on all this capital. So, deal by deal, we raise the money, if we're raising $2 million to buy a facility, until 2 million's raised, we buy the facility and we're off and running, and then we go and do it again. But I just feel as an investor myself and as a sponsor, I feel like that aligns interests much better.
Yeah, I definitely agree with that. And I understand the pros with the funds, but the thing that was with the individual syndications, you're able to really drill down on your due diligence. And also, I don't like the idea. It's like people, you have sponsors living off of acquisition fees, and they're really pushing stuff that doesn't fit. And that's what I see, or I feel might be a thing with certain funds where, hey, we're going to buy 5 of them. And, 2 or 3, 2 is like screaming deals. And then one of them's okay. And the other 2 are just, they're okay, but they're, you know what I mean? Sure. And I think if you really do your due diligence into them, see the funding, you see the area, like you said, how local it is, the location of it. Cause you'll see different properties, multifamily or self-storage, that are in fantastic locations. There's never going to be an issue renting these, you know what I mean? That's but they might put something that's not the great in the fund. And if you're putting money in, April, you don't know what they're buying in August. So it's something that everybody, I know they put out a plan and they tell you what it is, but I definitely agree with what you're doing. It's, I definitely agree how that works, because that's how we work, because we're not going to push it. And if we do deals, we do deals. And if we wait a few months between them, that's what we're going to do.
Right. I would just comment on the fee situation there. We do charge acquisition fees, and the reason is we have a great team, and they don't work for free. So we have a great team on the front end that's looking for acquisitions, like I mentioned earlier, the off-market acquisitions. I mean, that takes a lot of work. Yep. We're probably looking at 50 deals for every one that we close on. And then we have all the administration and the accounting and the taxes and insurance, all that stuff that needs to be handled. So we do charge fees up front. It ends up, in the grand scheme of things, being a small percentage, probably 15% or less of our total compensation in a deal. But it's just something that helps us as a company to, pay our great employees and keep the lights on, and et cetera.
Yeah, no, I definitely agree with it. We charge acquisition fees as well. It's just something that you see some sponsors out there that might be, they're really fee intensive in the beginning, and they're, they might be beginning sponsors, and this is kind of how they're generating some of their income as well. Where it's like you said, the traditional 2 and 20, or how we normally work in this private equity world, is that, like you said, it's supposed to keep the lights on, and that's the whole goal. And then you're really making your money on your carry. So
that's right. That's right. And again, I mean, as long as we're talking about, potential risks that investors should look out for, I would say it's a risk if your sponsor is not charging a fee, because how are they keeping the lights on, and how, are they really a legitimate sponsor if they don't have that team behind them that, that are getting paychecks?
Yeah. That's the one thing. Whenever you hear about acquisition fee, with a new potential investor, and that's their question, it's usually not going to work out, because you've never vetted properties before, and how many properties you have to go through. And 50 seems, I would imagine sometimes you guys even do more than 50, properties you're looking at. So, especially in a tight market, might go up to 100. So that's a lot of work, and you have to be compensated on that. But, so Tom, over the years, what have you found to be your biggest challenge?
Biggest challenge has been just getting the right people, I would have to say. When we do find the right person, and it's like, it just helps to explode the business. But if you find someone, and you do your best to interview, and through that whole process, but if someone gets through that process, you can kind of tell in that first 90 120 days if they're really going to be a fit or not. And so that, obviously not everyone's going to be a total 100% rock star every day, all the time. But I think over the years, that's been where we've had the most success, is where we've found the best people.
Right. Okay. So Tom, over the years, from finance to real estate, how has your relationship towards money changed over the years?
Yeah, that's a great question. I mean, early on, of course, you're struggling, you're trying to make that money, pay the mortgage, raise the family, save for college, those kinds of things. Thankfully, I'm very excited and very blessed to be in a place right now where I'm kind of in a position to be giving back. So to me now, money is a tool to start giving back to communities, giving back to the people in the world that I want to help. So I've been able to help start scholarships. I've been able to build houses in poor areas. And so and then just, again, investing in our people. So we invest in our people. We do, fun things at the office. We do those kinds of fun things that the company's paying for. But now I see it as a tool to do good in the world.
That's awesome. That's fantastic.
Yeah.
So obviously you took a huge leap back in the mid 2000s, and how have you said that, you've made progress in your life by getting out of your comfort zone?
Yeah, I mean, that's the only way to make progress, right? Is, if you're just sitting back doing the same thing over and over again, you're going to get the same results, right? So I knew it when I was in the corporate world. I remember doing the retirement calculator, right? Like, you can go to your 401k company, they have that retirement calculator on there. I was like, this is not, going to do it for me. If I saved, 10 or 15% of my income for, 30 years, I might be able to have some kind of retirement. I mean, that just didn't settle well with me. So I had to force myself to go out and take a leap of faith and just go for it. So I find myself now continually trying to learn new things and get out of my comfort zone and push into different areas. And so now, being leadership, leadership is tough, right? I mean, I work more on probably the humanitarian, kind of the personal side of the business, probably more so than I do on the number crunching side of the business anymore. And so that's been a whole learning experience. But I think I wouldn't change it for the world. I think it's the best way to grow and achieve is you got to just keep pushing.
So thanks so much for coming on today, Tom. How can our listeners learn more about you and your business? I know you have your safe checklist and some other items.
Sure. Yeah, Charles, it's been great. Thank you, buddy. Again, I'm Tom Dunkel. I'm the Chief Investment Officer here at Belrose Storage Group. You can find us at belrosestorategroup.com. You can also find our company page on Facebook under Belrose Storage Group, where we post my podcast interviews and a lot of other articles and things that we find are interesting or valuable. We try to give back to our community by just educating and sharing things that we're seeing out there. And then the safe ebook is available on our website. It's totally free, and we call it a checklist because we really do want people to print it out and actually mark it up, take notes on it, and then when they look at the next deal, print it out again and look at that next deal. But this has been great, Charles. Appreciate the time and the invitation.
Thanks so much for coming on, and we're looking forward to connecting here sometime in the future. So have a great rest of your day.
Yeah, thanks.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.